Hello and welcome, I'm Cody Koch, and this video is part of my question and answer series in which people ask me questions and I give them the best answer I can. Let's get to it. Cody, you've talked about your experiences as a day trader at a hedge fund. What do you recommend for someone trying to get into day trading? Okay, so this is a very interesting question to me. My answer to this would be it depends on your experience level. If you are an entirely new trader, you've not had any experience trading, I would really recommend not day trading. I would recommend starting off with higher time frame trading. Higher time frame means you own a position for a few years, many months, a few weeks, or even a few days. I would recommend mastering that first because there's a lot more room for error. Whereas in day trading, there's a much tighter space for error. You can't make a lot of mistakes. You have to do everything perfectly. And if you're really not sure yet what works and what doesn't work, then short-term day trading can really mess you up. You can lose a lot of money. You can get yourself in a lot of trouble. Now that said, if you're an experienced trader and you've already had success at higher time frames and you'd like to dabble into day trading, I can definitely give you some advice in that. So the first thing I'd say is to recognize that all trading requires movement. Let me give you an example. Imagine you have a stock that sells at $20 every day and it never moves around. Just $20, $20, $20, $20, okay? You cannot make money with that as a trader. It's impossible to make money. Alternatively, imagine there's a stock that existed that was complete random chaos. Let's imagine that that stock traded somewhere between $0 and $1 million a share. And so you wake up one morning and that stock is selling at $1,000 a share. You wake up the next day and that same stock is selling at $850,000 a share. The next day it's selling at 50 cents a share. That complete random chaotic movement where there's no real pattern to it at all. Decent traders and even some less than decent traders could actually make a gigantic fortune with a stock like that. And it's simply because you would buy when it got somewhere near a low part of that range and you would sell when it got to somewhere near the high part of its trading range, for example, and you could make a gigantic fortune with that, even though it's completely random and chaotic. It's just because of the massive amount of volatility, the movement. That's how traders make their money. Now, the reason I'm saying it like that is because day traders require a lot of movement, like all traders. The problem is there can be long periods in markets, going 5 to 10 year periods, in which the markets are actually very quiet. And during those periods, day traders struggle dramatically making money. On the other hand, environments in which volatility is out of control, price movements are very dramatic, day traders can make fortunes in those cases. An example of this was 2008 and 2009. Of course, the collapse that happened in 2008 created a tremendous amount of volatility. There's a lot of cases in which during those times, day traders perform best. There can be long periods, and I've seen this a few times, in which you'll go to, for example, at the hedge fund I was a part of, you'd have 100 traders there, let's say. During a 2008-2009 collapse, 80 or 90 of them would be making good money out of those 100. But during quiet periods in which the VIX index, let's say, is very low, all right, which can last for a long time, you will find that out of those same 100 traders, maybe only 10 or 20 or 30 of them are actually consistently making decent money at all. The rest at best are breaking even or losing money. The first thing to understand about day trading is it doesn't work for long periods simply because there's not enough movement in the market and there's absolutely nothing you can do about it. Another thing I like to say is the profits in trading, as I've said, in day trading are incredibly small. At the hedge fund, for example, we averaged profit of a penny per share. Okay, so every little bitty thing matters there. You cannot make a mistake because it can easily cost you 2 pennies, let's say a share, and you're suddenly very unprofitable with your day trading. So that said, I would highly recommend you figure out a way to actually profit off of the bid-ask spread in any stock you're involved with. There are ways you can do this. If you cannot make the bid-ask spread, I would really recommend you at the very least neutralize it. So what do I mean by that? So the bid-ask spread, many of you probably are familiar with this, is normal. It's built by liquidity. Sometimes brokers do this to profit off of people. There's a variety of reasons there's a bid-ask spread, but any given stock will typically have a bid-ask spread. In the New York Stock Exchange, on average, the bid-ask spread is about 0.5% the value of the stock. In the case of the NASDAQ, it goes anywhere from 0.5% to 2.5% the value of the stock. It varies a little bit. In over-the-counter and pink sheet stocks, the spreads can be dramatically wider than that. When you're day trading, 2.5% is absolutely gargantuan, okay? In terms of the amount of loss you can take if you're actually paying that bid-ask spread. So for those of you who aren't sure what I'm talking about, the bid is the highest, let's say the best limit to buy order available in the market at that moment. And the ask is the lowest limit to sell order in the market at that moment, okay? So that's what you're going to see between the bid-ask spread. If somebody's very motivated to sell immediately, they're going to hit the bid. And if somebody's very motivated to buy immediately, they're going to hit the ask, okay? This is how this works. Well, this spread is very important because it does represent a cost. If you go in there and hit the ask to buy your stock, and then when you go to sell, you hit the bid, you've just lost this bid-ask spread. You've just lost this small. Now, it may only be a couple of pennies, but like I said, it on average is 0.5% to 2.5% the price of the stock, depending on the exchange you're trading at. So that little bitty spread can actually add up massively as a day trader. So what you really want to try to do is try to figure out how you can buy at the bid and sell at the ask. There are a few brokerage firms that actually make this difficult, but many brokerage firms are very good and they'll allow you to participate in the market like that. If you can buy at the bid and sell at the ask, you'll actually make that spread. So you want to do that as much as possible. Now, if you can't make the spread, then what you're going to want to do is you're going to want to actually neutralize that spread. Let's say, for example, neutralizing the spread would mean you buy at the bid and when you go to sell, you sell at the bid, okay? Or you sell short at the ask and you go back to cover that short at the ask, okay? So that's a form of neutralizing the spread. But generally speaking, you want to try to make the bid-ask spread because those few pennies that are in there can literally make the difference between you having a profitable day trading system or an unprofitable day trading system. I'd also like to say that markets, intraday markets, have a tendency to go down, okay? So this is very interesting, and I'm going to show something on the screen here in which stock markets all over the world, if you actually notice, if you bought on the open and sold on the close every single day in those markets, you would have lost an enormous chunk of your portfolio, okay? With the exception of China. I don't know what's going on in China, but for some reason, they probably some regulations and rules they have in place that kind of flips this, or their data is erroneous on this, I'm not sure. But what ends up happening is by buying on the open and selling on the close every day, you're going to lose a giant amount of money. It's not sure exactly why this is. There's a bunch of theories floating around on why that is. I'm not going to go into those. But just notice that as a day trader, if you've got to close by the end of the day, close out of your positions by the end of the day, you on average are playing an environment that if you're trying to buy and go long all the time as a day trader, you're actually very much have the wind in your face with just kind of the nature of markets. You're actually better off selling short on the open and buying back on the close, and at least in theory, you will actually make money with that over time, okay? So just kind of keep that in mind. All profitability in the stock markets in the long run come from overnight gaps, okay? So the overnight gaps is the market gaps up overnight. It's very interesting to observe that, but it's something a lot of people are unfamiliar with. I don't want to make this video too long because it's supposed to be a short answer kind of thing, but something else I would really recommend, and I'm going to make this brief, is that there are a handful of very important fundamentals to investing and trading that you're going to have to get right. First, you need a profitable system that on average makes money that you've tested. You can first back test it using manual charts, or you could back test it using data or whatever. You could manually back test it yourself, or you could, if you can know how to code, you can use software to back test this system. You start trading it live in the market with a very tiny position size. Do not buy a lot of shares until it's proven that the system works on a tiny position size, because I promise if it doesn't work with a tiny position size, it's not going to work with a much larger size. Once you get that tiny position size tested and proven that it works, then you can start sizing up in your position size. Here's what I'd recommend. The most important thing to all trading is your psychology. So you got to get that straight. Second most important thing is your position sizing. Very, very important. Third is the market you're going to trade, whether that's stocks or futures or currencies or whatever. Fourth is the market condition, because whatever that market is, what's its current condition? Sometimes market's trending very well. They're going up. Great. Other times that same market may be crashing terribly, and that may last for 6 months, a year, something like that. The market condition is very important. Systems are very sensitive to the market condition. You're going to have to design a system for each type of market condition you come across. Next is your exit or management strategies. So how you manage the investment or trade after you've gotten into it. And this is the same in all time frames, not just day trading, by the way, but how you manage it once you've gotten into it. That is incredibly important and one of the most overlooked aspects. In fact, I talked about position sizing being the second most important thing behind your psychology, but if you don't have good exits set up somehow, your position sizing often doesn't work very well. So you must have great exits to properly position size, so they're actually indelibly connected. The sixth factor is your transaction cost, especially in day trading. That's very, very important because there's such tiny profit potential in day trading that you have to worry about your transaction cost, your execution cost, the bid-ask spread, and all of this stuff. So you really need to focus on limiting that as much as possible. Finally, number 7 on this list is your setup and entry strategies. Believe it or not, it's the least important of all of these factors I've talked about. It does matter. You do need to get into the markets, but I've actually found in my tests many times over that setups and entries are often not a whole lot better than random. It's actually your exits and your position sizing, the market you're in, the market condition that actually make the big bulk of your profitability, and understanding how to work with all of that and create systems around all of that is super important. Okay, so that's how you kind of understand how to build a system. Again, test it, small position size, start to size up if it goes in your favor, and then you will grow into that over time. All right, everybody, if you enjoyed this video, please click that like button to let me know so I will know to continue to do more videos like this. Okay, everybody, that's it for me on this Q&A. Thank you for watching.